Big Bear AI, a company that is in the defense sector, which is heavily funded by the United States government, just reported a $213 million loss for the fiscal year of 2025, with only $127 million in revenue for the fiscal year of 2025. So, by traditional standards, that means that this stock should be getting crushed even worse than it is at the moment. But, however, they still remain close to the $4 range. And they should, again, to mention, they should be trading at even lower lows. And what's going on here with this stock specifically? Today, we're going to be discussing and see why valuation alone does not equal the stock price. If you do enjoy videos where I break down stocks like Big Bear AI or the growth stocks, please feel free to comment below what it is you would like to see and upcoming videos in the future. Now, when it comes to Big Bear AI, let's start off with the raw numbers. The revenue they reported was $127.7 million, and the net loss they had was $213.9 million. So clearly this shows that they lost more than 1.6 times their entire revenue, which is a massive red flag. Then, when we look at the valuation metrics itself, we look at the EPS. It was negative 0.82, improved from negative 1.27 from the fiscal year 2024. So at least that's one good thing about the valuation metrics. But when we look at the PE ratio, it doesn't exist because it's negative. The PEG ratio is useless, and the PB is negative 47. So it's negative equity, showing that they have more liabilities than assets. So by traditional valuation metrics, this company completely fails. So why this is misleading? We do have to take into account that with when it comes to Big Bear AI itself, because again, as I did mention, they did report their 10K not too long ago. First off, why the value? There's going to be two metrics I'm going to be going over. First off, why this can be a little bit misleading is because when you take a look down in the report, when it goes into where it shows the goodwill impairment being $70.6 million and long-lived assets at $53.4 million, and you combine that, that's about $124 million in non-cash charges. So this is accounting, not actual cash leaving the business. So if you adjust for that specifically, the reported loss of $213.9 million actually adjusts to, after adding the $124 million, the adjusted loss then ends up being only $90 million. Now, that's still negative. It's still not good. And it does show that they still have a decent amount of losses with the $127 million in revenue that they had last year. They have high costs, and there is still revenue concerns, because as we do look at the last, not the 10K, but the quarterly, even though that it technically there was lots of bullish data points with it, lots of bullish points, and it was technically an earnings beat, they still did miss revenue, and people were pretty disappointed with that. So the whole point of the video and what I'm trying to get out, the core idea message here is because as I mentioned in the title, it does talk about how the stock price alone does not move just based on valuation. BBAI is being priced on future growth, the AI narrative, government contracts, and the potential for more government contracts to come in, and turnaround expectations. So, excuse me, guys, the market is not pricing what Big Bear AI is today. It's pricing what it could become in the future. But this is where you need to be careful, because for the high risk, when it comes to Big Bear AI, and just for visual appeal, let's take a look at actually where it does show, revenue, operating losses, because why not? It does show the, sorry guys, hold on. It's very late for me, guys, so my bad. But even though that I am having a little bit of a bullish, positive and not a pessimistic outlook towards Big Bear AI, I just want you to know that you still have to take into account the fact that there is still risk, even though we do take risk as investors, and we do analyze stocks and do our due diligence to manage risk. Risk is still going to be always there on the table. So you do have to be aware of the fact that even though I am going over the fact that valuation alone does not move a stock, and there are other factors in play when it comes to why a stock can move to the upside, you have to understand that this stock does have high risk. They're still not profitable. They have negative equity and likely still needs funding. So What I do want to let you know is that rather than just looking at the metrics for the PE or PB ratios, you got to focus on other things like revenue growth, cash position, cash burn, the path to profitability in the future, and the contracts in the backlog that they do have. So if you want more breakdowns like this, where we go deeper than the surface level metrics, please hit the like button, and it helps push to other like-minded investors just like you. So the next time you see a company with terrible financials but a strong stock price, don't assume the market is wrong. Ask yourself what the market is expecting in the future. So with that being said, guys, InvestQ out. Again, whatever videos you would like to see in future videos, again, please comment below, as I'll be more than happy to cover those videos. But again, with that being said, I'll see you on the next video. Keep making good decisions with your portfolio, and see you then.